Welcome to another deep dive. Today we're tackling Wall Street. Who knew that it all started with a 12-foot wall built to keep pirates out?
It's a far cry from the skyscrapers and stock tickers we think of today, right? But that wall, it tells us something crucial about Wall Street's DNA, even back in the 17th century.
Okay, so paint the scene for me. We're in New Amsterdam, Dutch territory, and what's the vibe like?
Think scrappy, ambitious, a bit rough around the edges, right? This wall wasn't just about pirates, though. It was about location, security, controlling the flow of goods and people. Sound familiar?
Hmm.
That's Wall Street in a nutshell, just with fancier suits later on.
So how do we get from fending off like buccaneers to bonds and bear markets? Was it all smooth sailing once that wall came down in 1699?
Not quite. New York City, it was growing fast and the port was bustling, but with growth comes volatility. Remember that. It's a theme. It's a theme we'll see again and again. By the 1700s, trade meant financing. And that's where the seeds of Wall Street, as we know it, were sown.
And I bet the Buttonwood Agreement comes in right about here. That always struck me as such a casual start to something so massive.
It's almost comical. Picture this. 1792. 24 guys under a buttonwood tree deciding to trade only with each other, setting their own rules. That, in essence, was the birth of the New York Stock Exchange.
Talk about humble beginnings. But didn't things get a little rocky pretty quickly after that? My notes mentioned something called the Panic of 1837.
Ah, yes. The first major crash on Wall Street. And, it was fueled by many of the same factors we see in later crashes, speculative lending, overconfidence, and a real lack of regulation. When a major British bank failed, it set off a chain reaction across the Atlantic.
So a crash course in early market volatility and a foreshadowing of things to come. That's a little unnerving. What's the lesson here for someone who's, say, just starting to think about investing today?
This is where history becomes incredibly relevant. The Panic of 1837 showed that even back then, diversification was key. Putting all your eggs in one basket, or in this case, one sector, was a recipe for disaster.
So we've gone from pirate walls to financial panics. What comes next in Wall Street's evolution?
Well, if the early 1800s saw the birth of Wall Street, the late 19th and early 20th centuries were like its teenage years.
Yeah.
Rapid growth, some questionable decisions, and a whole lot of figuring things out.
Sounds about right. And this is where those titans of industry come in, right? The Rockefellers, the Carnegies, especially J.P. Morgan.
Exactly. These weren't just businessmen. They were forces of nature, shaping industries, influencing government, and of course, leaving their mark on Wall Street.
I've always been struck by how J.P. Morgan stepped in during the Panic of 1907. It's almost like he was the lender of last resort before that was even a thing.
It's a legendary story. The entire financial system was teetering on the brink, and there was no Federal Reserve yet. So what does Morgan do? He gathers a group of bankers, locks them in a room, and essentially forces them to bail out these failing institutions.
Talk about taking charge. But this highlights something you mentioned earlier about regulation. It seems like each crash, each panic, is followed by this push for more rules, more oversight.
And that's exactly what happened after 1907. The creation of the Federal Reserve in 1913 was a direct response to the need for a more stable financial system, a way to prevent those kinds of near-death experiences.
Okay, so we've got a central bank now. Things are under control, right?
If only it were that simple. Fast forward to the Roaring Twenties, and we're right back to those familiar patterns. Speculation, leverage, a belief that the good times will never end.
This is where buying on margin comes in, right? I've always found that concept a little confusing.
It's simpler than it sounds. Imagine being able to buy stocks with borrowed money, amplifying your potential gains, but also your potential losses. It's like putting a down payment on a house. But instead of a house, it's a share of a company, and you're only putting down a fraction of the cost.
Ah, that makes sense. But of course, when prices started falling, everyone who'd bought on margin rushed to sell, prices plummeted further, and boom, Black Tuesday.
And it wasn't just a Wall Street crash this time. The Great Depression that followed, it affected everyone. From factory workers to farmers, shattering the illusion that the stock market existed in its own little bubble.
And this is where we see that pendulum swing back towards regulation.
Absolutely. The Securities Act of 1933, the creation of the SEC, these were direct responses to the excesses of the Roaring Twenties. The message was clear. Wall Street couldn't be allowed to operate without some guardrails.
All right, so the stage is set for a more regulated Wall Street. Did the lessons of the Depression stick, or did those old habits die hard?
It's interesting, isn't it? You see this push and pull between regulation and deregulation playing out over the next few decades. The years after World War II saw tremendous economic growth, and Wall Street benefited hugely. But as we've seen, periods of stability often pave the way for, well, let's say, a loosening of the reins.
And that takes us right into the go-go 80s, right? When Gordon Gekko told us that greed, for lack of a better word, is good.
The 1980s were all about pushing the limits, financially speaking. Deregulation was back in vogue, and with it came the rise of junk bonds, leveraged buyouts, and a whole new breed of Wall Street tycoon. Remember, we were talking about this earlier. The tension between innovation and risk is always there.
And then, wham, Black Monday in 1987. Another reminder that markets can turn on a dime no matter how much things have changed.
Precisely. It's like a constant stress test, seeing how much the system can handle before something breaks. But here's what's fascinating. Even Black Monday didn't completely derail the trajectory of Wall Street.
Because then came the dot-com bubble, which felt like a whole different beast. I mean, we were all so caught up in the excitement of the internet, myself included.
The dot-com boom and bust. It's a classic example of how new technology can fuel those old patterns of speculation and exuberance. Suddenly, everyone wanted to invest in anything with a .com at the end of its name, regardless of whether the business model made any sense.
It's almost like those tulip bulbs everyone talks about, right? A collective fever dream. Except this time, instead of flowers, we got Pets.com sock puppets and the NASDAQ taking a nosedive.
And yet, even after the dot-com bubble burst, Wall Street didn't stay down for long. In fact, it learned to adapt, to package and resell risk in increasingly complex ways. And that, my friend, brings us to the housing crisis of 2008.
The big one. Subprime mortgages, collateralized debt obligations, credit default swaps, all those terms that suddenly felt very important to understand, even if most of us couldn't quite wrap our heads around them.
What's crucial to remember about 2008 is how interconnected the global financial system had become. A problem in the American housing market, amplified by these complex financial instruments, triggered a global recession.
It's almost like Wall Street had become this massive, intricate machine that even the people building it didn't fully understand, let alone control. And when one part malfunctioned, the whole thing started to seize up.
That's a powerful image, and not entirely inaccurate. And where are we now? Post-2008, there were attempts to rein things in, with Dodd-Frank and other regulations, but the debate continues. How do we balance innovation with stability? Profit with responsibility? These are the questions that will continue to shape Wall Street in the years to come.
It's a lot to process. We've gone from a wooden wall to keep out pirates to a digital web connecting trillions of dollars in nanoseconds. What a journey.
And it's far from over. What's the next chapter in the Wall Street story? Will it be cryptocurrencies? Artificial intelligence, something we haven't even imagined yet. That's the thing about Wall Street. It's always evolving, always finding new ways to surprise us.
That's both exciting and a little terrifying, isn't it? I guess the only certainty is that there will be more booms and busts, more regulation and deregulation, as this constant dance between risk and reward continues.
And for anyone even remotely interested in understanding the world today, knowing how we got here is essential. Wall Street might seem like a world unto itself, but its history is deeply intertwined with our own.
Well said. It seems the real takeaway here is that the more things change on Wall Street, the more they stay the same. Thanks for joining me on this deep dive. It's been enlightening, if a little unsettling at times.
The pleasure was all mine. Until next time, remember, knowledge is power, especially when it comes to understanding the forces that shape our world.